What's going on, everyone? My name is Nicholas Merton here at Data Dash, and today is February 4th of 2020. Well, folks, I hope you are having a fantastic day wherever you are. And in today's video, we've got a wide range of topics to discuss. We'll mainly be focusing in on the key data science models of Bitcoin, really trying to guess where we are in the current cycle. And along with that as well, talking about some key headlines from the developments in China, as we had a massive sell-off across the board in equity markets, and also talk about the continued developments with Libra. So we've got a lot of things to discuss. Let's go ahead and dive right into it. Now, taking a look across the market here, we can see that there are, again, like yesterday, a lot of altcoins that are absolutely shining right now. Now, markets are relatively sideways. In fact, they're kind of pushing towards a downward trend. We've had a lot of the big plays like Bitcoin, Ethereum, Litecoin, general kind of market players that you know, pulling back here. But we are seeing some outliers here. In fact, we're seeing a lot that we've been supportive of for this year in 2020. First off, we've got plays like Icon and Alf that are doing 45 and 23% to the upside in the last 24 hours, as well as some other plays like Adara, Hashgraph, and Aeon. But we've also got some of our plays on there, such as Engine, Ren, and we've also got Basic Attention down here at 7% and Kyber at 5.4. So this is really good to see. I like seeing generally that my altcoin positions are moving upward in the market when we're getting these corrective periods. That tells me, again, we're positioned in the key players that even during fearful times, buyers are coming in and picking up positions, right? That's exactly what you want to buy. I know a lot of people have a conception. I don't want to so much call it a misconception because it can be true sometimes. There is such thing as value investing and buying things at a discount. But when it comes to markets like cryptocurrencies that are very momentum based and are very heavily based, especially in this period of time before we really get the kind of investing wave of individuals later on in the later part of 2020 and 2021, it's a very trader focused market. And because of that, it's very important to know how to spot momentum and to buy into momentum rather than trying to wait and wait for something to take off, right? So again, just a key point to keep in mind here when we're taking a look at the trends of altcoins versus Bitcoin, and then also again knowing in this case where to spot momentum versus just trying to buy something because it seems cheap, right? A lot of the things that go down 99% are never going to come back up. The dot-com bubble teaches us that. The mass amount of pharmaceutical stocks teaches that. And then also penny stocks, more than anything, probably teach us that, right? So anyways. All right, so let's go ahead here. Let's talk a little bit about the key data science models. And the one that I really want to focus on today, I think all three are very relevant to getting a picture of where we are and what's really important to focus on. I think the stock to flow model, again, really doesn't get as deep of an analysis as it should. I think a lot of people just generally look at the kind of broader picture, and I think it's great for this. It does showcase that the halving is a very important event coming up here in May, and it's been an important event in the past year in reflecting Bitcoin's price. But along with that, I don't want to just simply look at the surface here and look at our general target range for 90 to 100,000, right? That's generally where the stock to flow model is pointing throughout this period of time, somewhere in 2021, 2022. I want to go ahead and talk about how price weighs around the stock to flow line here, and also what we can gather from the last cycle. All right. Now we've had, again, really back here, there's been kind of two major periods of time where we had halving events here, back here in 2012 and over here in 2016 or late 2016. And we can see here that price reacts in different ways here. Back here during the first one, we actually had a bit of a front run to the halving model, right? Where price actually stayed above the stock to flow and continued pressing higher. And then along with that over here, we had one where we had a delayed response here, right? So again, what's more likely to happen this time around? Again, I think you'll hear different despairing arguments. Some people would say that we get something like this because we're going to likely have a front running to the halving because supposedly everyone knows about it. And then there's also some who would say we'd have a delayed response because as we saw in this cycle, what really happened was that there was the change in daily inflows and outflows. The inflows probably stayed relatively the same or were growing, and the outflows dropped in half because the miners could only sell half as much Bitcoin at the market price that it was at, right? Because miners are generally constantly selling their Bitcoin positions after they basically mine them. They don't keep them. It's not like the old days where it was a market of everyday people like you and I who were hobbyists who had GPUs mining crypto. You can't do that now. You have to go out there and buy these expensive ASIC machines. It's a highly competitive industry, and people are doing it much like they would for mining gold. They do it to get a margin, basically a spread of some sort from their cost to their profit of selling that Bitcoin. So that's the general gist here. And it's why you hear people shutting off their mining machines. You hear the hash rate declining when mining is not profitable. Okay. So I just want to drive that point home. So the question here, of course, after all that rambling and that kind of, I guess, kind of foundation for where I'm going to be making my argument is, what is the next cycle going to be like? I believe it's going to be a lot more like the previous cycle than the first cycle. All right. So the cycle we had last back in 2016 through 2017. And I'll explain why I believe this. The first reason I believe this is that what caused this to have a delayed response is going to be very similar to what we've had now. We have a lot of people talking about the halving event. Yes, some people have in their minds considered what the value should be, which is in the next couple of years, somewhere around 90 to 100K. But along with that as well, people just generally know about it more than the last cycle. That being realized, right, price is much higher than where it was back here. And along with that, we don't have everyone in the world knowing about the halving event. The vast majority of people in the cryptocurrency space who have bought into Bitcoin or have, participated in crypto in some way, they don't know about Bitcoin's supply schedule. Again, I'm giving a rough estimate of 90%. It could be more, could be less. We don't need to overanalyze it, right, guys? It's just basically getting the idea that the vast majority, if you are here right now, you are a part of an anomaly. You are a part of a small minority of people who actually care about understanding this stuff, which I think is cool. I mean, you're a data science nerd like me, right? There's nothing to be ashamed about it. In fact, sometimes it can pay off to know about this stuff ahead of time. But most people don't take the time to do the research, and that's fine. It can be a little bit complex for some people, or maybe it's just not interesting to some people. And then 99% of the world still doesn't own any form of cryptocurrencies. So this is the reason why, even though to us this seems obvious, it will have delayed responses until we get that change of inflows and outflows, until the miners stop selling as much. Because what happens there is you have the decline in sell side pressure cut in half, right? You have the sell side pressure cut in half. And then what happens is you have the same amount of buyers, roughly speaking, on a day-to-day basis. Now you're starting to get pressure to the buy side where prices start ticking up. And then as the cycle continues upward and we break past all-time highs and enter into the new parabolic cycle like we did back here after we got past the previous highs of 2013 here in March 2017. Then you enter into the late phase where the momentum kicks in and the parabolic run-up comes in. And the buy-side pressure keeps going up and up and up and up as the sell-side pressure stays relatively the same. Now, there might be a little bit of an increase, maybe some sellers taking profit, but there's such a divergence here where the hype cycle comes in. And this is why the halving event is so relevant. Now, we understand that, right? What is it going to look like here? Now, what is this line down here? This basically, the model variance here shows us how we correlate price alongside the stock to flow line here, this general kind of line that has this kind of zigzag pattern here as we accumulate, after we account for the stock to flow, right? The changes and the issuance of new Bitcoin, okay? So we can see here in the last cycle, right, we can see that price had remained steadily below the stock to flow line for a multi-month basis here, right? All the way back here from August when we first dipped below it, down here to July of 2017. Nearly a year before we really started playing serious catch up here. Now, that didn't mean that price was going down, right? Price was still going up. From that point up there, we went from $526 all the way over, and I'll go ahead and get it exactly here on the low. We got it right here at 1900, and that's even after a pullback here from 2500. So, point being here, Bitcoin, even during this period of time, though I don't think we're going to see the exponential gains here in the short run, right? We're still seeing pretty good run-ups here. I mean, we're talking about going, again, from $600 here, right? All the way up here to 1900, right? This could mean that we're pushing, again, if you took really the top here, we pushed more than a 3x here, which is pretty impressive considering that it wasn't even keeping up with the stock to flow model and we played catch up later. So let's go ahead and kind of get an estimate here. What can history tell us here? Of course, it's not going to play out exactly like it did last time, but what this will likely tell us is when we hit the halving event, right? If we're anywhere near the stock to flow line around 8,500, right? Let's do some simple math in our heads. Okay, so 8,500, and we're going to be expecting that we might get a 3x, and we're still going to be delayed behind the stock to flow model, right? So if, like in the last cycle, we're right around where the stock to flow line is at the time of the halving event, we come down and correct. Let's just say, take it conservatively, we're at 8,500, right? just putting it simple. In this case, we could expect some time over here in probably late 2020 to come back up to the previous highs and get above towards 25,500, right? And this would mean that after this, we're starting to really play catch up here. And sometime in late 2021, we start to tick up towards 100,000. That would actually make a lot of sense. And then be very similar to what we saw back here, where, for example, when the stock to flow model actually came out here and really kind of topped out in July of 2017, it took a multi-month basis all the way in towards December, so another half a year before we really started to reach the peak of the market, right? So again, bearing in mind that the peak here is on the stock to flow model is May of 2021. So it could be all the way over here, like last time, towards November or December before we get that peak. Could be even longer than that. The cycles might be getting longer than they are in history. But again, this is starting to hopefully give you guys a decent idea of knowing where we are. And just to explain it as well, the days until the halving shade is very important as well. We're getting very close here. We can see that we're entering into the purple channel here, which means that we're less than 100 days away here from the halving event. We're getting very close, guys. So it's very exciting to think that, coming up here in the next few months, we're going to be hitting this very, very important event. Now, along with that as well, I want to spend some time to go ahead and take a look at the logarithmic growth curves for Bitcoin. Again, you guys have probably seen me broadcast this chart on TradingView, and I think we've taken a look at the data science model before, but I want to emphasize its importance here in understanding where we are in the cycle. We are in the very, very bottom phase here, guys, and we can see here that historically, these channels give us a great picture as to whether or not Bitcoin is on the cheap side or on the exponential, over-exuberant, overpriced side, right? And it lines up very nicely with the previous highs here. We can see very clearly, as well as the lows. So we can see that we're on the lower end of the divergence here, right? We're down here at around a measure of 0.13 out of 1. So we've got a long way to go in this cycle. And we're just slowly but surely riding along the support line here as we should be doing, right? It's exactly what we did back here, back in 2012, back here through 2015, 2016, and also here in 2018, coming down in for a second low, right? Looks very similar to previous price action. Now it's a matter, again, of seeing this start to grow higher here, starting to see the oscillator start to grow even higher here, starting to test back up here towards the mid-range, and moving higher here for the parabolic cycle as we did in the later phase of the cycle once the halving has really started to come in after the retail and institutional investors have started to pile in. Again, the people who didn't care about these data science models investing later on once it's already trending, once it's already expensive and going up. That's the period of time where we start planning our exit strategy, right? That's where we start planning our strategy to start taking some profits, right? At least for me personally, I'm not telling you guys you have to do that. You might want to just hodl. I like to trade these broader cycles because they're very, very easy to predict if you understand the data science models, right? I'm not going to lie, guys. I want to make some trades here. I want to be able to take some profits at the top when I know that Bitcoin is overvalued and it's beyond the stock to flow model where its fundamental value should be, right? It's just logical in that case. That's very simple macro trading. And if there's other opportunities where my capital is going to grow better, I'm going to probably have it parked there, right? But I'll always, of course, keep some Bitcoin and cryptocurrency positions. I wouldn't want to get rid of all my crypto. It's always good to have a diversified range of exposure. But taking that into mind, last data science model here, the days of profitability. It's not much of an indicator here in the sense of being able to tell where we are in the cycle. But what it does tell us is that no matter what kind of volatility you see in the crypto market, no matter how much noise there is, how much down talk there's of Bitcoin. I remember just back a few months ago, does anyone remember when people were shouting that, oh my God, there's going to be a mass exodus from miners and that the Bitcoin network was just going to crash and the hash rate was going to decline. There was a huge miner kind of apocalypse. And along with that as well, people, just again from the headlines here, with Bitcoin going from 14,000 down to 6,000, it was dead and it was going to 5K and 3K. Well, it didn't. And there was no mass exodus. The hash rate's fine. And we're now at a point where 94% of Bitcoin's history, if you've bought it in the last 10 years, you are up on your money. Not many asset classes can say that. I sure as hell know gold can't say that. Over the last few years, there's been plenty of opportunities where I could have lost buying into gold or silver. And I love gold and silver. Same with equities. You could have bought, for example, Amazon or no, I wouldn't say Amazon. Actually, Amazon, pretty much every case you're up. But a lot of the tech stocks back in the dot-com era, and you're just finally starting to make a return above those levels, right, on some of your plays. Again, takes a long period of time. That was 15 years before we finally got back above the NASDAQ getting above its dot-com highs. That's the stuff to kind of put it in perspective here, guys. People have a big misconception that equity markets and commodities and all kinds of different asset classes are always reaching new highs. But if you're factoring in for inflation and you're factoring in as well just for past performance, it's not always the case. For something like Bitcoin to have this kind of performance, this exponential level of gains here alongside a history of profitability is huge. And it shows you that during these swings here, they may seem volatile. We have had a 50% increase here in Bitcoin's price here over the last few weeks, or a little less than 50%, but give or take here from around the upper 6,000 range to pushing up to upper 9,000, right? These things are important to take into perspective, like profitability here, right? The sheer fact that it has this kind of record of profitability and that you're only down if you bought through the absolute hype cycles from the recent little bump here or back here during December 2017 puts things in perspective. And I think it's because we've got a lot of macro things to be worried about, right? We obviously have what's going on in China right now that has led its market towards its worst sell-off day in a very long period of history. And it's so bad that China has to block short selling in their country, meaning being able to bet against stocks and make positions betting on the downward price momentum of the market. And along with that, they actually have daily limits for how far the market can go down. Just like how in the US we have circuit breakers, they have their own circuit breaker with a minimum of 9% downside. So this means that people who are still trying to sell their positions, sitting on the sidelines, who even got up early in the morning, they talk about here in the Bloomberg article, who wanted to sell their positions, couldn't because there was a restriction on it, that it can only go down 9%. So I think that gives some perspective here. Global markets are still yet again finding things to be worried about here, and I think it's getting to a point here where we're going to start seeing a lot of demand for hedges, as we've seen with gold, silver, and Bitcoin. Now, futures here, generally kind of along this kind of bank here, we're starting to see markets stagnate here, right? Not much growth here, not much of a rebound after a 9% dip across most of the China shares. So now that we understand that global markets are really starting to enter into a phase of fear and are looking for a variety of hedges that have growth potential, I think it's time that we actually understand how we can go about preparing for this next cycle of Bitcoin, where we're not only going to see likely Bitcoin reach new exponential highs, but along with that, see a lot of risk taking in the altcoin space that can provide a lot of great trading opportunities. And what better way to do that than to take a look through Clio? Now, for those of you who haven't seen Clio yet, they're one of our partners here on the channel. And Clio is a platform that allows you to build algorithmic trading strategies without having to know a single line of code. You don't need to know any Python, you don't need to know any R. You can just simply build strategies in plain English and plug them into your exchanges. Now, the nice thing about Clio is that you actually don't even have to join the paid plan right away. You guys can actually just test out for free and build strategies in plain English. And if you find one that you like, or if you make one that you like, then in that case, you can apply it to your accounts and actually sign up for a subscription plan. But I want to go ahead here, and in today's video, we're going to dive through and actually editing one of the current existing strategies. I want to show you guys what it's like to actually either modify or build a strategy to a degree. And we'll go through the full actual process of building a strategy later down the line, but in today's video, we'll get a good feel of the actual strategy builder here within the Clio platform. So we're taking a look here at the multi-asset hourly. This is one of the many strategies that I have on my dashboard. We're going to go ahead and actually click on creating a new version. So we can see this is a profitable one that trades a variety of different assets such as Engine, VeChain, Tezos, and Bitcoin. And it uses a fraction of our portfolio here, but it's actually been a pretty profitable one. So we'll go ahead and just kind of demonstrate what we've got here at the start. So this is version 4 of the multi-asset hourly, as I've made a few versions in the past that I've deployed. And we can see here that the backtesting and strategy settings showcases this is a cryptocurrency trading strategy. It's built for Binance in this case. We've applied it to Binance. In this case, we have an initial balance of 10,000 USDT for our backtesting. It is on a 1 hour time frame. This is important, meaning that when it's a 1 hour time frame, the strategy is looking at on the hourly to see if the standards of the rules have been met. And we'll talk about that in a moment. We also have a backtesting period here of a little over a year, and we also have a 1-to-1 leverage. So we're not using any leverage here. Now, when we're actually going about building these strategies, we need to meet 3 things, and luckily, this strategy has already met all 3 of them. We need to have an open condition, a win scenario when we actually look to enter into a certain set of assets. the asset and volume that we want to buy, which are designated here on the right-hand side, 10% of our balance and our portfolio going into Engine, 10% going into VeChain, 10% to Tezos, 10% to Bitcoin, and also having a designated close condition or stop loss. Having stops set so that we know when to take our losses and also when to take our profits through our trailing profit, right? So this is very important to keep in mind here. When we take profit, when we take close, and when we have all three of these conditions met, we've got a match made in heaven. It's only a matter after that of whether or not the strategy is profitable. Now, let's go ahead here and take a look at the first rule here, and that's going to be an important thing. We're actually going to see we can have multiple rules, which is pretty cool. So the first rule here showcases that when a candle, these given assets on the hourly, is a bullish Marubozu, which is basically, it's a very standard candle with a lower open and a higher close. So when the candle is a green candle here, and the wicks on either the top or the bottom is shorter than the actual base candle, then in this case, we're actually going to enter into a variety of these different assets. Whenever on the 1 hour time frame, any of them have reached in a bullish candle like this, right? Very simple, nothing complex here, guys. But this isn't the only condition here. We also have another condition down here, right? In this case, we have another rule that states when price is below the Bollinger Band lower band. So basically, as you guys know, the Bollinger Band is a pretty common trading indicator. When the Bollinger Band, when the price goes below the lower band of the Bollinger Band, in this case, then we see this as a value opportunity to buy into any of these positions. And we have the same exact stop loss, take profit, and volume balance on those trades and the same crypto positions. So this shows us a few things. We can not only trade a variety of assets in the same strategy, but we can have multiple rules in the same strategy. Now, you might notice as well, on both of these different rules, we only used one specific basically standard, or in this case, or basically condition. But we can have multiple conditions that we look for. We can get more specific. Now, again, one thing we're going to see here as we modify the strategy is whether or not we actually build a more profitable one than the one before, or one that's actually less profitable. And I'm going to make kind of a point here from my analysis of the Clio platform and where I've really found value. But we'll go ahead. We'll see here. We can get really specific here on our rules. So we can add another, for example, technical indicator. Maybe I want to add the MACD. And maybe, for example, as we have the condition here, I want to specify that the MACD is up by a certain amount. And in this case, maybe I want it up by a certain amount of points here in the last two candles. Now, I'm going to go ahead and actually modify this. You can actually edit the condition. These are just kind of standard layouts here. I'm going to go ahead and say is up by, for example, maybe 10 in the last two candles, right? Right, there we go. It finishes it. That's basically saying it's going up by 10 points in the last two candles on the 1 hour time frame MACD. Very important to notify here. We're talking about a specific time frame. And, maybe I want to add one more condition here, right? Maybe I want to see, for example, in the crypto fundamentals, I want to see, do alts. I want to see alts total volume up by, for example, 5%. Or maybe let's just say, for example, we'll do 5% in the last day. Very simple, right? Now, again, we have added a variety of other conditions here. And we can now go ahead. We have still checked off all three. We have our open conditions, our set asset and volume, and our close and stop loss conditions, right? So very, very simple. Let's go ahead and build the strategy, see what happens here. Do we have a more profitable strategy? So we actually didn't build a more profitable strategy this time. We built one that's still profitable here. It's pulling in a 25% total return from our back test, or an annualized return of 24.5%. So we still made a profit here. And we're placing a variety of different trades here. If we go down here, we made a total of 301 trades here across our different assets. So it's still profitable. But what does this show us here, right? If we go through here and actually start building these new strategies, is this going to come at a cost to us? No, it's not, guys. It's just one of many versions here. It's, again, one of many different types of strategies that we've built, or versions of our strategy. And it proves the value of back testing. We're not deploying this to our Binance account yet. We're actually going through and testing it here before we actually deploy the new version, right? And it shows us here, in my opinion, as I have explored through Clio, I think the cool thing is that you can have multiple different rules, but I tend not to use too many different conditions on those rules, meaning that we need to have a large amount of standards before I enter into a position, because in that case, you just end up not trading too frequently, right? And I'm not saying you want to make it too loose here in this case. I tend to not want to trade too much in my personal trading strategy. But at the same time, I want to make sure in this case not to use too many different indicators to where it's a make or break moment where I won't trade a given asset. So that's a very key thing to keep in mind here, guys. But it'll depend on your trading strategy. If you're more into scalping and trading more frequently and making marginal profits and even think you can combat against the fees and commissions that you have to pay and turn more of a profit, then that's okay. That's completely fine if you want to have more different conditions. But it depends on your strategy. All right. So that's our little analysis into Clio today, guys. Again, I recommend you guys go ahead, try it for free. It's a really cool tool, and I think it's something that could add a lot of value to you guys. For those of you who want a little bit more of an active position in cryptocurrencies and want to get into more automated trading. So I think it's very cool. And again, I think the back testing is so important. Now, one last thing I wanted to mention here in the sense of news here for cryptocurrencies is that MasterCard has officially quit Libra's cryptocurrency project. So we've talked about Libra for a long time and the slow but inevitable kind of demise of Libra, not only due to its ties to Facebook, but also the centralized nature of it. And we've not only seen PayPal and Visa leave, we've also seen MasterCard leave as well. So it stinks. I think in this case, again, I think it proves here in this case that we're not going to see a centralized crypto win out in the long term. I think Ethereum is leading the way, guys, in the sense of stable coins and financial use cases. With the layer 2 scaling solutions that's coming to Ethereum and the expansion of the DeFi space, I think this is ever more relevant in this case, taking this news here and the slow demise of centralized projects like Libra. A lot of that market momentum that came with Libra, the applications that could have been built on Libra, I think are now going to go to Facebook. It's just something I wanted to toss out there. I think it's very important to watch this because it's something that hasn't been talked about a lot recently, but it's still one of the biggest news pieces in relation to cryptocurrencies. So anyways, I digress, guys. I hope you're having a great day wherever you are. And if you like this video, drop a like. Leave a comment as well on anything that we talked about in the video, guys. What are you interested in? What topics, have gotten your eye at the moment? And outside of that, guys, I'll see you all in the next video. Stay tuned.